This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney.
And I'm Paul Allen. The top stories this hour. Asian stocks set to follow Wall Street lower after a sell-off in US chip makers. Nvidia extending its longest slump since 2022 ahead of Wednesday's earnings report.
President Trump said to be considering higher tariffs on China over allegations of excess capacity ahead of next month's planned summit with Xi Jinping.
And oil prices ease as traders assess the US plan to isolate Iran economically, including threats to punish its trading partners.
We do have some breaking news when it comes to the situation for geopolitics around Ukraine and some of the support that we've been seeing from allies. We're hearing from Burnham planning a US trip next month to lobby President Trump when it comes to the issue of Ukraine aid. He's speaking in a Bloomberg interview in Kyiv, saying that Ukraine has been running low on a stockpile of interceptors. That issue is fixable, and that European leaders may meet around the United Nations General Assembly meetings to talk about the issue of how to further support Ukraine. So we are hearing now from a Bloomberg interview that the UK Prime Minister Burnham is planning to travel to the United States next month to lobby President Trump to let Ukraine access some of its Patriot air defence missiles ahead of the winter, and that European leaders are considering holding another coalition of the willing meeting around the UN General Assembly meeting with a view to be able to secure these American interceptors and stocks from other countries as well. President Zelensky, of course, of Ukraine, has made repeated pleas to European nations and allies and to the US to help Ukraine obtain these Patriot missile interceptors to replenish its stocks in time for winter. Russia, of course, at that point expected to ramp up attacks when it comes to energy infrastructure, so trying to get in before that. So Prime Minister Burnham there speaking in a Bloomberg interview in Kyiv on Monday evening. In the meantime, let's take a look at the setup, because we do have, of course, quite a lot of geopolitical news flow going on. We've also got the situation with Iran, with the US telling Iran's trade partners to cut ties or face sanctions. So we will be watching the impact of that, particularly when it comes to crude markets. The other thing, obviously, that we're watching very closely is the situation with Treasuries. We're seeing some gains across Treasuries at the start of a potentially very pivotal week there for the US bond market. Yields across the session were pretty low across maturities in the Monday session. But the key question really is whether we're going to see Treasury Secretary Scott Bessent, what he's going to do next, these details of the kind of financial initiative that's been hinted at to tackle the budget deficit woes. I spoke about oil and the situation with Iran and some of the economic pressures that we're seeing the US press, not just on Iran, but of course its trading partners as well. Oil is pretty steady at the moment, a little bit of a gain when it comes to New York traded oil. And we're seeing further gains with that dollar debasement trade with the likes of gold, Paul.
So, President Trump threatening to ratchet up tariffs across multiple trading partners from China to Canada and beyond. Our team is here with the latest. China correspondent Min Min Lo is in Hong Kong. White House correspondent Jeff Mason also joining us from Washington, along with Canada Executive Editor Derek Decloe in Toronto. So, Min Min, let's start with you. Bloomberg has learned the US is planning to impose 7.5% tariff on Chinese goods. What do we know about this?
Well, this is according to what sources have been telling Bloomberg. It has not been officially confirmed by the White House, but sources are saying that the U.S. is looking to impose these tariffs ahead of the Trump-Xi summit, and this will be imposed under the Section 301 investigation into Chinese overcapacity. The results of that investigation will likely be published ahead of that summit, and this would bring the total tariffs under Trump's second term to 20%. Now, if you recall, it seems like so far China is tolerant of a 20% ceiling on tariffs. This was what was discussed and agreed upon previously in Kuala Lumpur at the sidelines of the ASEAN summit last year. And so far, China has not responded or retaliated against any tariffs that doesn't go above that cap. So this is potentially something that could happen, although the exact rates are not final yet. And another option, according to sources, is that the Trump administration might impose higher tariffs, but then suspend a portion of it and only impose the 7.5%. So this really sets us up for the Trump-Xi summit that is expected to happen in September.
Yeah, and it goes to the expectations for a reaction or expectations from Beijing, right? There's obviously a lot of negotiations and a nuanced building of this relationship before we get to that summit.
Yes, and again, when it comes to the Trump-Xi relationship, I think expectations in general, according to the people I've been speaking with, has been pretty low, at least the maintenance of the status quo. I think sources have told us that the two sides are still looking to extend that trade truce, which expires in November. But one of the lowest hanging fruits for now, as a key deliverable, would be the Board of Trade and finalizing what are the goods that would be eligible to be tariff-free, some $30 billion worth of goods that might be able to get exemptions from tariffs. But on the flip side, this also means that everything outside of that $30 billion worth of goods identified would be touched and impacted by tariffs. And this is, of course, coming at a time when China's economy has been pretty sluggish, right, except for exports, which is one of the only bright spots. And so those tariffs will be hitting at one of the only more resilient parts of the Chinese economy. And then, of course, there are all the other issues like the tech issues, Taiwan. Those will likely still be discussed, but we're not expecting any big breakthroughs from the summit.
Our China correspondent Min Lo there. In the meantime, the US Treasury Secretary Scott Bessent has also threatened economic punishment against any country doing business with Iran as part of what he calls the economic D-Day campaign to end nearly 6 months of war.
Let me be clear. Any entity that facilitates money laundering on behalf of Iran will be removed from the U.S. dollar system. The clock just started ticking.
Let's bring up Bloomberg, Washington and White House correspondent Jeff Mason. So we've been waiting for the details of this ultimate economic pressure campaign for a while. And obviously, it's less about pressure that the U.S. can exert against Iran and more about what it can convince the likes of China to be able to do.
Yeah, it certainly is. And that was a question that Secretary Bessent didn't entirely address today. He was asked specifically about China, and he gave a broad answer, basically saying that any country that is doing business with Iran will face these types of consequences. But he didn't get into the specifics on how they intend to deal with China on that. So that will absolutely be one of many things that are on the list of issues that hang over that upcoming summit that you were just talking about previously.
Yeah, it begs a couple of questions. What if China and also India don't play ball on this? And if this was such a good idea, why wasn't it done earlier?
I like that last one. That's one that I would like to ask as well. And if we have a chance to ask it of the president in the coming days, I think somebody certainly will. I would certainly love to have a chance to do that. That is the question. I mean, this is a war, or we're in the middle of a war that the president started with Israel earlier this year that has had a bunch of unintended consequences for him politically and for the United States economically. And it certainly does raise the question of, excuse me, if they knew all along that there was an economic D-Day option, why is that not the one that they went with? I think we can parse some of the answers to that. Number one, the president has lost his appetite for additional military strikes right now, but he also is not willing to say we've lost. That's really not in his vocabulary, and he's not in a position, because of the status of the negotiations with Iran, to say necessarily that the United States has won, which doesn't mean he won't say that, and he has said that, but clearly the conflict is still ongoing. And so this is the next step, and it's a broad step, and the secretary didn't have a lot of very specifics, but that's certainly something that we'll be following up with over the coming days as the president holds these conversations with foreign leaders that Secretary Bessent referred to.
Yeah, in the meantime, we are hearing from the president speaking at a tally rally again, saying the US is beating Iran very badly. They can't have a nuclear weapon. Gas prices are going to go down. At the same time, we are seeing a clear kind of shifting of focus away from the military conflict to back to the trade war, right? Is this part of kind of a calculation in terms of going into those midterms, that this idea of trade conflicts and again bringing it back to kind of building America back up again is going to play better at the polls?
Well, if it's part of a calculation, I'm not sure if it's paying off because the trade war with Canada will have another consequence of bringing prices up, certainly on those goods that were coming in to the United States from Canada that are now going to be tariffed and going both ways on that. So, yeah, I mean, certainly the midterms are at the very top of this White House's agenda. It's a crucial election for Republicans who currently have power with all of the institutions in Washington, including both houses of Congress. So there's a lot on the line. But the president's "Make America Great Again" theme and America First strategy has been part of his strategy since he got into office, and certainly it's how he got into office in the 24 campaign. So I don't think you're wrong to say, is he focusing on that right now? But I think the unintended consequences that we were talking about with regard to the war also refer or would be an appropriate thing to talk about with regard to the trade exchange with Canada now too.
Bloomberg, Washington and White House correspondent Jeff Mason there with the latest. And of course, the latest front on this trade war has been Canada, right? Reportedly set to announce retaliatory tariffs against the United States on Tuesday after President Trump threatened to double levies on Canadian autos to 50%. Canadian Prime Minister Mark Carney says he's still willing to negotiate if Washington changes its approach.
The goal of our trade negotiations with the United States has always been to get the best deal for Canadians, never a deal at any price or on any time frame. Well, we made progress, and we did make some progress in recent weeks. In the end, that momentum reversed, and we could not accept what the U.S. had offered, nor could we give what they asked.
Let's bring Derek DeCluit, who is our executive editor for Canada. Derek, really great to have you with us. So it's a very, very strong language that was used, right? In fact, I think the one that stands out for me is Prime Minister Carney talking about just the attitude, a sort of destructive attitude that he sees coming from Washington.
Yeah, that's right. There was kind of a twofold message today. One was Carney said that it was kind of clear to us that the Trump administration really wants to crush several really important industries for Canada, one of them being the automotive industry, steel, aluminum. He used very strong language on that. And at the same time also made it clear that the door is still open to negotiations. And he used that right attitude line. If the Americans bring the right attitude, what is the right attitude? It's in his words, to not treat Canada as a subsidiary of the United States, to treat it as a sovereign nation and a partner, as it has been for decades. So we will see where this goes, but there's certainly no indication that talks are about to restart.
Derek, if this does escalate, and as you say, it looks like it will, what's the likely impact on Canada? And does Mark Carney have the public support to go down this path?
Right now, he definitely has the public support. There was a weekend poll that shows about 3 out of 4 Canadians say he was right to walk away from those trade talks. And all of the provincial premiers who have a lot of influence, they appear to be behind him. But of course, Canada has not really felt the economic pain of this latest round of tariffs. They've only been in effect for a few days now, and the escalation from Trump today against the auto sector, proposing 50% tariffs against Canadian autos starting in January. I mean, that would render every Canadian auto plant basically unable to export into the U.S. So that would be extremely painful from a jobs and income point of view, especially in the middle of the country. So we'll see how the support holds up.
Derek, when it comes to the leverage that the Prime Minister has, obviously there's key industries like critical minerals, like energy. Prime Minister Carney's been quite cautious about this in the past, but does the sort of very adversarial nature of this relationship now suggest that this could be on the table?
Well, I think he's going to continue to be cautious about using, oil in particular as a lever. There are a number of technical issues with curbing the flow of oil or taxing it. That is a really strong weapon that I think he has expressed reluctance to use. I think what you will see starting tomorrow is counter-tariffs that they will apply to certain U.S. products that are made in, sort of politically important areas of the United States in some ways. And he's also spending some time touting the importance of the Canadian market to U.S. exporters. I mean, it's not lost on anybody that while Canada exports a lot of vehicles to the U.S., the opposite is also true. And in fact, Canada is the biggest market for the U.S. in a whole bunch of different categories. And so, consumer boycotts and counter-tariffs, I think these are the tools of the moment, probably within Canada.
All right, Bloomberg's executive editor for Canada, Derek DeCluet there. Still to come, we're going to talk market strategy with BMO Wealth Management, who say they're staying overweight on growth stocks and focused on the US. Much more ahead on the Asia trade. This is Bloomberg.
We haven't bought a single bond yet. The next time we have an operation is September 9th.
US Treasury Secretary Scott Bessent there responding to questions about whether he'll increase bond buybacks in the near future. For more on the outlook for the bond market, let's bring Garfield Reynolds, who leads our Bloomberg MLive Asia coverage. So we're sort of in a little bit of a holding pattern at the moment, Garth, aren't we? Because there is sort of waiting for more details to see what Scott Bessent can say or do in terms of addressing the fundamental problem, which are these concerns over the budget.
Yeah, that's something that was not addressed today, and Scott Bessent last week said that he would be coming up with fiscal consolidation plans. He name-checked the White House budget chief, Voigt, that he was working with him about how to do that. That is the biggest concern for investors when it comes to long-end treasuries. I mean, inflation is also a concern, but the biggest concern by far is the fiscal deficit, the potential that it is getting out of control. It keeps on getting larger. While the Trump administration did try methods that it said would restrain the budget, that being tariffs on the revenue-raising front and the DOGE attempt at government efficiency on the outlays front, neither of those have done anything. Meanwhile, cutting taxes and boosting military spending and the inevitable ticking higher of expenses on Medicare, Medicaid, other so-called untouchable programs, all that means ever greater amounts of debt. That's a major concern for investors across the curve, but especially further out the curve. So far, Scott Bessent has not done anything that could be seen to persuade investors that he's got a handle on how to rein that situation in.
Yeah, it's not just the US government issuing treasuries or bonds, it's the chip makers as well, really getting very active in the debt space also. And we saw a sell-off in tech today in the US. How much of this is to do with the bond issuance? How much of it is to do with NVIDIA price increases? Or is it to do with all of this, and where are we heading?
Well, that's all playing a role, along with the policy uncertainty. But the biggest difficulty is that you had a really parabolic run-up in the AI trades of various stripes, and it sort of pivoted from one to the other to the next. First it was all about NVIDIA, then it was about the so-called hyperscalers, then it was about the picks and shovels, Micron, Samsung, Hynix, TSMC, companies that make the chips that go into the bits that go into the NVIDIA chips and the bits that go into the data centers. All of those soared, and profit expectations are still very, very generous. The difficulty is that the way maths works, at some stage you start to see a slowdown in the growth rate. As those growth rates slow down, investors have to readjust their expectations for where profits are going to go. And we've also seen at the same time cash flow being used up and then companies turning towards debt. That rings alarm bells, because when bubbles pop, and there's been lots of concern that the AI boom, however justifiable some of it has been, does look a lot like an historic bubble. When bubbles burst, debt is often at the heart of it. So That's a big issue. And indeed, there's an interrelated concern, which is one of the things that is helping to drive long-dated debt higher globally, are concerns about inflation. How do you rein in inflation? Well, one way is you get central banks to hike rates. But central banks hiking rates is, again, traditionally the key way that bubbles popped. That's what happened with the dot-com boom. That's what happened with the housing boom. So that, I think, is lurking in the background for tech companies, that at some stage higher interest rates, both at the short end and at the long end, are going to add to the burden as those profit expectations start to roll over.
Right, so that dark shadow in the corner could be history. Garfield Reynolds, who leads our Bloomberg M Live Asia coverage there. Thank you. Time now to look at some morning calls ahead of the Asia trading day. Interest rate strategists at Goldman Sachs and Wells Fargo say the US Treasury Department's bond buybacks will do little to reverse the jump in long-term yields. They say the steps will be ineffective unless Washington addresses concerns about the swelling budget deficit and inflation pressures that have been pushing rates higher. JP Morgan portfolio manager Kelsey Barrows says anxiety about heavy supply in the bond market might be overblown. Barrows says the US investment grade market faces a busy September with issuance expectations in a range of $175 to $250 billion. She says demand has kept pace with issuance, with retail demand at the highest since 2010.
Well, Guggenheim says investors should be selective in AI and data-centered related debt. CIO Anne Walsh told us more about why they see higher Treasury yields as a potential buying opportunity.
Here we are in a trading range on the 10-year. And at the low end, we've been down into the high threes. At the high end, we're 470, 475. And at 475, that's pretty much the high end of our range. If we see 5% on Treasuries on the 10-year, I would tell you that is a buying opportunity. I think the markets aren't able, particularly the equity markets, aren't really able to function as well beyond that. And I do believe it tightens financial conditions. The 30-year, however, historically has traded much more on inflation concerns. I don't see us going to 6% on the 30-year. And if it does, I would take the opposite view and I'd back up the truck. And I buy a lot of 6% 30-year Treasuries. I think that at this point in time, what we're also seeing, I said stratification earlier, we're seeing that also in the pull up. Another factor that's happening, and that is the sheer amount of debt that's being issued, not just at the Treasury level from fiscal spending, but also because of data centers and AI trade, the AI trade that's happening at this point in time. And as a result, we're seeing this very significant amount of need for capital, and they want to issue in the long end, which is pulling rates up.
Do you want to invest in that debt, long duration, hyperscaler debt, or do you see that as potentially more toxic than U.S. government debt should things turn south?
I think there are other parts of the infrastructure trade that make a lot more sense. Power build out and other kinds of long-term real asset investing. My concern about the data center build out and the cost of that is the obsolescence risk in the long term. Now, I am selectively an investor in shorter duration offerings, but we have to be thoughtful because the AI offerings that are coming out of the capital market are not in just one place. They are in unsecured investment grade credit, they're in structured credit, they're in infrastructure. So you have to be really thoughtful to make sure that you're getting the right amount of diversification.
It's Guggenheim CIO Anne Walsh speaking on Bloomberg Surveillance. More ahead on the Asia trade. This is Bloomberg. Let's take a quick look at the oil price after the US tells Iran's trading partners to cut ties or face sanctions. We also heard from Sinopec saying China's oil demand likely peaked last year. So we've got crude stabilizing. Brent at the moment 92.17 a barrel. More ahead on the Asia trade. This is Bloomberg.
This there's a lot at play at the moment, but you look from geopolitics to what we're seeing in Treasury markets, right? And I think when it comes to the Treasury market, we are fundamentally waiting for Treasury Secretary Scott Bessent to be able to give more details or say a little bit more in terms of how he wants to address what investors are truly worried about, which of course is the budget situation. But in the meantime, we didn't get any more kind of details or signals on how he plans to revamp the debt management situation. There was a report that Treasury could draw down on some of its cash pile to fund buybacks of higher yielding older securities. We didn't get any more details on that other than him saying we haven't bought a single bond yet. So that's the picture when it comes to 30 years. In fact, we're doing a whole lot of nothing at the moment. S&P futures looking mildly positive after what had been a challenging day, because even as we had a pullback on oil prices, we did see that tech sell-off really remain pervasive, and that's going to play through when we get to the start of trading here in Asia.
Yeah, I did enjoy Citadel's description of those buybacks as well. Financial repression of risk weakening the US dollar. So yeah, it's interesting watching this play out. Also interesting to watch the latest on Iran. I mean, we were anticipating something from Scott Bessent, and something we got, telling Iran's trading partners to cut ties or face sanctions. It has served to, well, put something of a floor under crude prices. New York crude there, 85.17 a barrel. So this is also sanctions on 60 Iranian entities that would target a number of things, including gold, oil, aviation, shipping, technology as well. Economic asphyxiation is another descriptor that Scott Bessent used when describing the approach to Iran. Also some news flow on US approach to trade with China as well. 7.5% tariff coming on Chinese goods, the reason being excess manufacturing capacity, and the timing so interesting just ahead of President Xi's visit to the United States to meet President Trump next month. Haidi.
Yeah, that would restore the second-term duties on China to around 20%. It's still consistent with the trade truce, these levels, according to Beijing previously. But let's bring in Carol Schleif, who's the Chief Market Strategist at BMO Wealth Management. So, Carol, so not only do we still have war in the Middle East that's still unresolved, it seems like we've got the Trump administration now shifting its focus back to the trade war as well. How does this impact investors, do you think? Are you seeing the impact on sentiment yet?
Well, I definitely think it's impacting the questions, the incoming questions we have, not only the trade issues with China, but obviously with Canada and what's gone on over the weekend. But yeah, the interesting thing is from an investment standpoint, we're just coming off this gangbusters earnings season when we had lots of economic data that was supportive of super strong earnings. Now we're kind of in this never period until we get in after Labor Day. So we've got a couple light weeks, light trading volume, light market scenarios, other than the fact that you've got a big NVIDIA announcement this week and you've got Jackson Hole at the end of the week. So you've got big events, but with the lighter volume, it can tend to push markets around. So clients start opening that worry closet up, bringing out all of these things to focus on. Trade is one, tariffs are another, inflation is another, the long run. There's a whole long list of things that people will buffet the markets around over, and because now that we set aside earnings for a while.
Carol, with what's going on with long-end bond yields, Treasury yields in particular, how much do we start to see that playing through? Because you say that you're still overweight growth, not just AI, and predominantly in the US, but does the bond market tell you that some careful rebalancing needs to happen now?
It definitely, and investors for the first time in a very long time have some choices so they can take some money off the table, do some rebalancing, if you will, in order to keep their portfolio allocation where it needs to be, because clearly stocks have run this year again. We're double digits for 4 years running now. And so having opportunity to be able to shift some of that into fixed income. But it's important to assess, which we wrote on this in the last week or two, it's important to assess why those long bonds are going up. And there's a variety of reasons, but one of them is because growth is strong. And that's why the longest end of the bond is going up, along with the excess supply or the extra supply that you've got coming in there. But bond market in general tends to take it better if the what's pushing the yields up is organic growth, and we are seeing that.
Where do you place the risk of seeing a correction in equities, particularly in the US before the end of the year? You know, we've got AI borrowing, spending ramping up, and if you saw a correction, would you buy that dip?
As long as the fundamentals continue to play out like they're teed up to play out, the answer would be yes. We've been a long time since we've had a normal pullback. We haven't even had a 10% pullback, which tends to happen, every year or so. And there's lots of charts that we use that show even in very strong up years, you've got a natural pullback in here. Last year we had it related to the Liberation Day tariffs. This year, we had a pullback when the war started, but it was nowhere near as severe as the one a year ago, even though you've had under the surface, you've had a lot of individual sectors and segments and stocks that have had severe corrections this year that have allowed the overall market to be up. But yeah, it would not at all be surprising to see some sort of a pullback.
Yeah, potentially linked to the debasement trade as well. And is that something you're looking at, as the US dollar weakens? Do you look at gold? Do you look at emerging currencies? And do you look at crypto, perhaps?
Well, and it's interesting, we don't have crypto. You're still trying to figure out what sort of an asset is it, does it play in that. It's clearly playing in here as investors are lumping it in with the debasement trade. Gold is probably, for those who can't sleep at night because of geopolitical risk and other things, probably has a place in some portfolios. But I would be careful. I think we'd be careful about calling it the debasement trade, if you will, similar to the fact that we didn't necessarily buy the Sell America trade last year either. So, and you even saw the dollar rebound some today when people were looking for havens. So the dollar stabilized a bit for a bit.
Now, we've got a very important speech coming up at the end of the week. Of course, Kevin Walsh going to be addressing Jackson Hole. I mean, he's explicitly said previously, don't expect any forward guidance. So what is the best you can expect from this speech, perhaps in terms of what's happening with inflation and some potential reaction to what Scott Bessent's doing in the bond market?
I'm not sure we'll get much of that, and clearly I'm not sure it's gonna be like a normal press conference. I think he gives a speech, no Q&A afterwards, but hopefully, ideally, we would get a little bit of insight into any progress that he could share about what his 5 task forces are working on. Because as you know, they're talking about the impact of AI, they're talking about communications, they're talking about potential data sets and changing up the data sets the Fed looks at. And I know he's given them till the end of the year, ideally to wrap it up, but he's also said he hoped some of the work would be done by this fall. And so hopefully he could give us a little peek into a progress update on those would be great.
All right, Carol Schleif, Chief Market Strategist at BMO Wealth Management. Thanks, as always, for your analysis. All right, let's look ahead to the open in Korea at the top of the hour. Perhaps unsurprisingly, seeing a little bit of weakness in Kospi futures after we saw tech selling off pretty hard in the US session. Samsung Electronics down about 2% in the pre-market. SK Hynix off about 2.5%. And of course, Asia traders will be pricing in a pretty sharp fall in chip stocks today after what we saw in the US market, still digesting Nvidia's planned price hikes as well. So for more on what we can expect, so let's get to markets reporter Anthony Stevens. Anthony, safe to assume it's going to be a risk off for Asia chips stocks today?
Yeah, it's an interesting one because Asia led the way lower yesterday. We had Kospi close down 3. Some of that was around the Samsung shareholder kind of return plan, would be disappointing. But also Hynix caught up on the downside. And one of those concerns is now whether chip makers can pass on these supplier costs to NVIDIA, right? Given the fact that NVIDIA was only able to raise prices 15 to 17%, that's a lot less than some of these chip prices on the NAND side, on the DRAM side, on the HBM side have gone up. So NVIDIA is eating some of these cost increases, and how long that can continue is clearly the question markets are pricing. We saw a very sharp divergence overnight with the hyperscalers outperforming the chip makers. So it wasn't a tech on, tech off story in the US. It was the fact that the customers of the chips were outperforming as they look like they're going to be starting to get some cost pressure back. and the sellers of chips underperformed, as it looks like they're unable to pass on more of these price increases going forward. So you had the likes of Micron trading quite sharply lower, and that has an obvious read-through into Korea, given its predisposition on the memory side of things. So it'll be interesting to see how much further Hynix falls. It's very interesting for me to note that the ADR premium in Hynix has collapsed from around 49% to 29% coming in today. So even though the headline ADR hasn't moved that much, the premium implied has come off very sharply. So maybe US retail is kind of giving up on Hynix there. Also, you see significant outflows from tech-specific ETFs like DRAM or SOX US. So there is a little bit of deleveraging from the retail side as well on the semiconductor trade. And all that is important going into the NVIDIA earnings. NVIDIA is down 7 days in a row and punctuated that streak with a 2.9% drop yesterday.
In terms of what we're seeing with the cash flow situation for the hyperscalers, are things starting to turn?
They are reporting more income while they are doing a lot more capex as well. So like the net cash flow situation is probably not changed. They are adding new verticals that are bringing in cash money. So for example, the custom chip index, the custom chip initiative from the likes of Google, Alphabet, Microsoft, they continue to gain pace. There's a lot of estimates out there that TPU demand, meaning the custom chips, can start to catch GPU demand in 2028. That is a mega trend on the chip world that we need to start watching, because who makes the chips for these hyperscalers is drastically different from who makes the chips for NVIDIA. That entire supply chain will be in play when Taiwan comes online, and their memory demands of those chips are also quite different from NVIDIA chips. So there's a lot more homework the street needs to do to make sense of how the hyperscalers are moving forward in the back half of this year.
Our Bloomberg Markets reporter Anthony Stevens. More ahead here on the Asia Trade. This is Bloomberg. Well, we are rounding out the earnings season. Still a few to go, a few big ones to go, but what's been really interesting is that divergence between how the banks have performed versus how the miners have performed. And obviously there's sort of idiosyncrasies within each of them. The miners are really interesting because when you think of Australian miners, obviously the classic trade is iron ore, is China, but we know that with the slowdown in the old industries, the old economy for China, that's still making demand has been diminishing as well. Iron ore is still a key component, obviously, for the likes of Fortescue, BHP, Rio Tinto, but you see with the likes of BHP, for example, is it a copper miner now? For the very first time, more revenue being derived from its copper business than iron ore.
Yeah, copper, the new iron. And even Fortescue, you mentioned there, pure play iron ore miner, until recently diversifying into copper. Interesting timing. Different story for the banks, though, really diverging there. And as you say, is it an idiosyncratic story? Is it a rates rising, changes to the property market tax regime, oh, nobody wants to buy property at the moment story? So there's a number of headwinds there for the banks, depending on which bank we happen to be talking about. Now, energy stocks have been performing somewhat divergently as well in Australia as well. And we've just heard from Woodside Energy, actually, first half profit jumping 27% as Middle East supply shocks pushed oil higher and LNG prices as well, which did offset lower production. Bloomberg's Kira Wright joins us now with more from Melbourne. So Kira, tell us about the key takeaways from this earnings report.
Good morning, Paul. Yeah, as you mentioned, we actually saw net income rise 27% in the 6 months to June, which was a bit of a surprise. It was higher than analyst estimates, so a bit of a, I guess, exciting surprise there for Woodside. And it came despite hydrocarbon production falling, which, as you mentioned, it just really goes to show this prolonged impact of the war in Iran and how we're seeing that play out in our energy companies here in Australia.
What are the main things that the market was really watching for in this set of earnings?
I would say that probably the key project that the market was really paying attention for this time around was the Louisiana LNG project. It's the company's first project offshore of its kind, and we really saw some higher spending of it in the last couple of months. That higher spending really saw Woodside's credit rating fall quite a bit. And I think that what we're going to continue to see looking forward is this process of trying to secure new partners for that project.
So what's next for Woodside then? Any lingering questions that might be expected on the analyst call?
Yeah, absolutely. I think other than that ongoing equity sell down project that we're seeing for Louisiana LNG that I just mentioned, Browse also remains a really large question mark for Woodside moving forward. So the Browse natural gas project, of course, is really required to feed gas into Woodside's major Northwest Shelf export project. But there are a lot of lingering questions, both in terms of regulation. There's been some, latent questions in Australia here about whether there potentially could be an a tax on gas exports, which would obviously have major repercussions for the project. There also has been some legal challenges and a lot of activist pushback to Browse, which is a quite carbon-intensive project compared to other similar projects around the world. So if we saw any of those, challenges really gain any particular speed, that could definitely pose a big issue for the company.
Bloomberg's Australian energy reporter Kira right there from Melbourne. Some of the other earnings reports that we're tracking this hour, and PDD shares closed lower in New York after the Temu owner's second quarter sales missed estimates. Revenue grew 8% from a year ago to $16.6 billion, but adjusted earnings of 19.33 yuan per US share comfortably beat projections. PDD is facing global regulatory pressure, including over the quality of goods available on Temu. XPeng ADRs closed in the red after its third quarter forecast for sales and shipments missed estimates. It expects vehicle deliveries of up to 121,000 units for the period, compared with analyst forecasts of 147,000. Meanwhile, XPeng says its robot unit plans to raise $900 million from investors, including Alibaba and Tencent, bolstering its push into humanoids. More ahead here on the Asia Trade. This is Bloomberg.
Let's get the latest now from the corporate front. The US SEC is said to have sent subpoenas to major Wall Street banks over the hedge fund situational awareness. Sources say it's seeking information about trading activity at the hedge fund, which came under pressure last month. Situational awareness liquidated some of its positions amid a barrage of margin calls during an AI stock rout before Citadel stepped in to buy the bulk of its bets. Bloomberg's been told the Taiwanese prosecutors have indicated a senior NVIDIA manager as part of a group that allegedly smuggled advanced AI chips into China. Sources say 2 senior employees of Supermicro Computer were also indicted. They're accused of organising the shipment of 74 servers containing high-end B300 chips into China via Japan and Indonesia, which is in breach of US trade restrictions.
Well, South Korea's cultural exports have become a global phenomenon, from K-pop to TV dramas and movies. And as AI reshapes industries around the world, one company is betting robot idols could become the next evolution of K-pop.
As much as Samsung and SK Hynix have thrust South Korean markets into the spotlight this year, the worldwide popularity of groups like BTS and Blackpink, shows like Squid Game, and beloved romantic dramas have been an economic boon long before the meteoric rise of large language models. Music, films, video games, and other Korean cultural industries generated over $113 billion in revenue last year and more than $15 billion in exports. They employ about 690,000 workers, more than double the combined number at the memory chip giants. South Korea's entertainment sector has grown more experimental and ambitious as competition intensifies. One startup looking to disrupt K-pop's traditional idol system is Galaxy Corporation. It's looking to blend AI characters and life-size robot idols to create content without the limitations of human performers. CEO Choi Young-ho says they are not looking to replace people, but create new IP.
Robots can learn everything at once and immediately perform it for people, whereas it might take a person a month or two to learn the same material. The time savings are enormous, and it all happens simultaneously. Once the training is complete, there's no need to do it again, so we can immediately have a robot trainee debut in New York. It doesn't require the 3, 5, or 10 years of preparation that humans need. That's how AI is changing everything.
Galaxy was founded in 2019 and started as a TV production studio behind the Netflix hit Physical 100. Its current roster includes K-pop superstar G-Dragon, actor Song Kang-ho from the film Parasite, and San Francisco Giants right fielder Lee Jung-woo. Galaxy has now opened a 16,500 square meter robot park in Seoul, where visitors can interact with around 50 different types of robots. Choi plans to open new robot theme parks in other major cities including Dubai and run a robot idol tour from next year. Among its partners is Unitree, China's first publicly traded humanoid maker.
Even if the hardware, the robot, is made in China, combining it with software made in Korea and joining forces to go global holds great significance. Above all, I believe these robots will become part of people's lives as new editions are released, including special editions of their favorite celebrities that they can collect.
While Galaxy is showcasing one of the first real-world use cases for these robots, Choi says discussions on global guidelines need to take place.
AI is already part of our lives. What's somewhat disappointing, though, is that we don't yet have global guidelines that match its development. Whether that means global laws, systems to protect against risks, or security frameworks. The same wave is now coming with physical AI, and we must not make the same mistakes again. We need to establish global guidelines to ensure that robots do not harm our lives.
Galaxy is now preparing for what could be the first major overseas listings by a K-pop agency, with the goal to file for an IPO in New York and Seoul by late next year. The company has raised about $150 million so far and is targeting an overseas pre-IPO round this year. Galaxy's planned debut will be a test of whether the next generation of entertainment companies creates next stars or codes them. Soe Kim, Bloomberg News, Seoul.
Let's get to some of the top global headlines that we're following. Indonesia's president says companies responsible for forest fires polluting the air in several countries will have permits revoked. Prabowo Subianto visited the fire zone in Kalimantan as a Swiss monitoring group said the Malaysian city of Kuching recorded the world's worst air quality. IQ Air also listed Jakarta, Kuala Lumpur and Singapore among cities with Monday's worst air quality. The world's ocean temperature has hit a record high as climate change combines with a powerful El Niño in the tropical Pacific. Europe's Earth Observation Agency, Copernicus, says the global average sea surface temperature last Saturday was 21.1 degrees Celsius. That is the highest since daily tracking started in 1979. Higher ocean temperatures increase the chance of extreme weather events. Haidi.
Take a look at what we're watching when it comes to this dollar debasement trade, right, as we continue to see gold surging ahead. That's been one of the biggest beneficiaries as we continue also to watch for Treasury Secretary Scott Bessent at this point refraining from any further signals when it comes to his management of US debt. There had been a report of that potential plan to draw down some of its cash pile to fund buybacks of these higher yielding older securities. At the moment we're seeing gold again advancing to that 3-month high, the debasement trade just returning. Concerns over US fiscal policy, the impact on the greenback there, driving gold to the highest intraday level since about mid-May, a third weekly gain last week that we saw as well. The market opens in Sydney, Seoul and Tokyo next.
This is the Age of Trade. We're counting down to Asia's major market opens, and Haidi, once again, trade is front and centre. We've had plenty of news flow on that front as well, but also a tech correction in the US.
Yeah, the tech correction remains very interesting, particularly when it comes to some of the pricing issues or pricing concerns that we're hearing around NVIDIA, as well as going into NVIDIA earnings, of course. But, you know, it is interesting. We have unresolved actual military conflict, right? And we're now seeing the US calling on, you know, some of the biggest trading partners of Iran to do more. So that's going to be an interesting dynamic for China and the US, particularly ahead of the leadership summit in September. At the same time, the trade war very much revived. We've got these overcapacity, so-called overcapacity tariffs being set on China. We've got the situation with Canada as well.
Yeah, it's going to be setting up for an interesting conversation between Trump and Xi next month in Washington. But yeah, we've just opened for trade across the Asia Pacific, so we've got Japan up and running now.
Yep, the Nikkei up coming online just about 0.5%. And as you mentioned, Paul, the recovery when it comes to the tech trade in the US remains pretty fragile, and some of that is going to pass through, particularly when it comes to the likes of Japanese markets as well, as what we see always with that pass through for Korea as well, right? But what's interesting with this kind of revival of the dollar debasement trade, we are at least getting some pressure being taken off the yen. The yen has been holding quite steady. 159 level is what we're seeing. JGB's also seen a little bit up as well, after we heard from Treasury Secretary Scott Bessent refraining from any further moves or further signals to move on the revamp on US debt management. So we are expecting JGBs to be tracking those moves in Treasuries higher today as well. Speaking of the Kospi, let's take a look at how we're faring when it comes to this very tech-heavy gauge. Of course, we'll be watching for that direct correlation between what had been trading overnight. We've had a few sort of developments. The US has been pressing South Korea for a memory chip plant investment as well in the country to ensure the stability of chip supplies. Apparently that was an issue that was discussed during the industry minister's recent visit to Washington for these trade negotiations. So we're hearing some reports of that for a semiconductor investment as being also separate from the $350 billion US dollar investment that was agreed by the US and Korea last year as well. We're seeing some downside across the board, but in particular for the heavyweight Samsung and SK Hynix. Hynix is down by over 4%.
We've also just opened for trade here in Australia, seeing some modest gains for the ASX at the moment, up about 0.25%. Those gains pretty broad-based as well. The big sectors of finance and materials are both in the green at the moment. A couple of stocks to keep an eye on. Woodside, the energy producer, right now up by about 1.7%. This is after first half net income beat estimates. Coles Group, meanwhile, this is the supermarket giant. First full-year net income missing estimates. That stock off by about 1.3%. Crikey, liquor EBIT, big cratering there, down 48%. Australians obviously drinking less, having an impact there. A lot of action, though, happening in the bond space, although the 10-year pretty much parked where we left it, just above 4.7 now. It was just below that mark at the close. 30-year yield, meanwhile, 5.23%. We had some colourful language from Citadel today, calling the Treasury buyback financial repression that risks weakening the US dollar and fueling inflation as well. We did hear from the Treasury Secretary Scott Bessent a bit earlier. Let's have a listen.
We haven't bought a single bond yet. The next time we have an operation is September 9th.
Morgan Stanley says the US Treasury could source between $80 and $200 billion to fund its expanded bond buyback operations from its cash pile parked to the Fed. Our markets reporter Anthony Stevens joins us now for more. So we're still sort of in wait and see mode, but there's questions in terms of how effective this is going to be.
Yes, those questions center on the feasibility of moving kind of the weighted maturity of the treasuries, right? And in that context, this new kind of commentary around using the Treasury general account to raise money to influence this buyback is interesting. Now, that account, there's around $950 billion that sits in that account. It is the day-to-day kind of checking account for the Treasury. And of that, around 100 to 200 billion is available according to Morgan Stanley and others. Now, how much impact can that $200 billion have? Now, that's going to be a very interesting question. In short bursts, yes, it is meaningful, and yes, it does add some credibility to the firepower on hand for the U.S. Treasury. But in the long run, against the long-run fundamentals, that is a little bit dubious. And what it also ends up doing is pushing issuance to the front end of the curve. And you do have that kind of flattening of the curve impact from this messaging already. Now, what happens next is probably going to be another focus. Where does the outlet from this change in monetary policy come through, right? And most likely that's going to be on the US dollar.
Yeah, let's talk about the US dollar. Of course, we saw a pretty steep decline in the dollar spot index in the middle of last week, but it's crept back up a bit since the lows that we saw on Friday. What's the direction of travel here? What's the trend?
Yeah, you're seeing a variety of short dollar trades here, right? You had the big rally in gold, you have the recovery in crypto, even though it's hit its head near the kind of technical resistance levels. But you're also seeing the carry trade emerge in a really big way. The carry trade is starting to have some really good sharp here now, as both the yen and the dollar become very easy funding currencies. The G10 carry trade index just keeps going. It's up around 14% on the year now. That is equity-like returns for an FX trade, right? So that's going to continue to attract capital. And on emerging markets index, FX index has broken out to the upside. Now that really removes oil as a headwind from emerging market FX, and that's a very new dynamic for emerging FX traders, and they're going to lean into that while the Treasury is so aggressive in trying to tamper down on yields, right? The outlet, as I was mentioning, for the yield move is in the FX. That's where people have to price in the fact that the US is trying to control its yields, trying to control its rates downwards, and that is an obvious corollary to the rest of the world where there is more normalized monetary policy, especially in emerging markets that are trying to control inflation, and the G10 currencies like the Aussie dollar, like the Kiwi dollar, that have much more focus on inflation. So for now, the short dollar trade, especially when you have a carry component or you have a rates differential component, seems like a very easy trade for FX traders to lean into.
All right, markets reporter Anthony Stevens there. Thank you. Let's get to our next guest. Jung In-Yun is a CEO at Fibonacci Asset Management. Jung, thank you so much for joining us today. And I do want to start with your points on AI-related corporate debt issuance. You see this becoming a market risk, but we're not at that threshold yet. When do we arrive at that point? Is it possible to tell? And is it inevitable?
If you look at the corporate debt issuance from the AI companies last year, it was about $12 billion. And this year already it surpassed $200 billion. And that's a nearly 24 increase of private sector tapping into the debt market. Now, we don't think it's going to slow down. We'll probably see the corporate debt issuance by AI companies only increase with the progression of time. The problem is this is happening at a time when we have a high interest rate and the demand for the US Treasury has temporarily weakened. And that's going to cause some ripple effects across the world.
Now, you also note that there is a difference between how US and Asia fund AI investments. Which approach do you feel is the more sustainable one?
Well, I think if you look at in Japan, SoftBank is raising 1 trillion yen from issuing bond to the retail investors. I think that's a healthy approach because if we have too much strain on the public debt and the government is issuing bond and the corporate companies are issuing bond and everybody is raising debt while the demand is overwhelming the supply, then the only answer is that the price of money, the interest rate has to go up. Now, if you can use the retail pocket and diversify away some of the pressure, that's likely to be more sustainable.
This huge amount of debt raising is also happening at a time when we're seeing upward pressure on bond yields, right, Treasury yields. Do you see the confluence of these two factors very quickly overlapping in terms of how much that capital is going to cost?
Well, we seem to have a vicious circuit here. Higher demand for AI increased the chip price. That increased the amount of capex required, which then ultimately increased the required return from investing in AI that might fuel back into the higher AI chip price. So this vicious circle seems to be already in motion, and right now it's not a crisis yet, but certainly it is a market risk.
You wouldn't call it an AI debt bubble yet. What markers would you be looking for where you start getting worried about that?
I think if we see the 10-year yield, U.S. Treasury yield, hitting above 4.8, then the amount of the premium that needs to be paid will be reflected in the private bonds. If you look at the CDS premium for some of the tech giants, it's not just Meta, it's also other AI-related companies. The CDS premium is creeping up fast. And this is not a healthy sign. At some point, investors will start asking, look, we made this massive commitment today, hoping that someday we can monetize from AI, but what if the return that's going to be generated disappoints significantly? Then that's going to be an inflection point in this debt cycle.
Well, considering the risks that you've just unpacked for us, what's the best approach for investing around the AI story at the moment, and how do you hedge against those potential risks?
So I think it's important to distinguish AI companies into two groups. One that spends on CapEx, and the other that's receiving the CapEx. Some companies keep spending enormous amount of capital, hoping that in the future this AI investment will pay off, while others are actually collecting cash now. So if you look at the Asia semiconductor companies, they're raising prices. NVIDIA is obviously raising the server price by more than 15%, tells you something that while all this chicken game is going on, some companies are actually making profit today. So distinguish company that makes money now from the company that hope to make money in the future.
Do you think that it is a very real possibility that AI can be both transformative and productive, but that the financial returns from AI may remain disappointing?
I think it's plausible, and I think this thing can coexist. I have no doubt that the AI is transformative and it's very real. It's impacting our daily lives and also the job market at the same time. However, when every individual company assumes that computing demand will exponentially grow in the future and start investing in the AI infrastructure, it may seem rational from individual company level. However, from collective level, if everybody is thinking the same thing, there will be duplications, redundancy, and inefficient allocation of capital somewhere. That will probably drive down the expected return from AI.
Jung and Yun, really great to have you with us, CEO at Fibonacci Asset Management. More ahead on the Asia trade. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Bloomberg has learned that the US is set to impose an extra 7.5% on Chinese goods over allegations of manufacturing overcapacity. Sources say it could come before next month's Washington summit between Presidents Trump and Xi. Let's bring our China correspondent Min Lo. So this brings the total tariffs from the second term of President Trump to around 20%. Is this still, I guess, relatively acceptable in terms of where the trade truce lies?
Yes, it is relatively acceptable. This was what the two sides had discussed and agreed upon, a 20% tariff ceiling. They agreed on this in Kuala Lumpur at the end of last year at the sidelines of the ASEAN summit. So this latest edition, if it comes through, it will likely not spark any retaliation from China for now. And this is going to come through after the conclusion of the investigation into Chinese overcapacity, the results of which, according to sources, could be released soon before President Xi's trip to China. And again, this is coming amid, of course, a lot of expectations for that summit. Both sides are expected to extend the trade truce, which expires in November, although some sources are saying the Trump administration might consider imposing higher tariffs and then suspending a part of the tariffs, but then still eventually imposing just 7.5% just to stabilize relations there.
So, Min, you say there may not be any reaction from China, but the timing certainly is interesting. What's the motivation behind the timing of this announcement?
Yeah, the timing coming ahead of the Trump-Xi trip, right, potentially setting the stage for any negotiations between the two leaders. And of course, both leaders will want to ideally deliver some wins for their countries when Xi is in the U.S. And of course, there are really very few areas where we expect breakthroughs. One of the lowest hanging fruit, for example, is the Board of Trade, which has already been dangled or hinted at in May when President Trump visited Beijing. But so far, many months, it's been discussed for many months, but then there has not been any details in terms of what sort of goods would be earmarked to be exempted from tariffs. So perhaps both sides might discuss that and come up with more concrete details around that. But then when it comes to all the other areas, particularly when it comes to tech export restrictions and, of course, China's rare earth export controls, whether those will be delayed. Perhaps Trump imposing those tariffs would provide a bit of bargaining chip to ensure that China would also continue to keep its end of the bargain and extend the trade truce as well.
Bloomberg's China correspondent Min Lo there. Well, Canada will reportedly announce retaliatory tariffs against the United States on Tuesday after President Trump threatened to double levies on Canadian autos to 50%. Prime Minister Mark Carney says he remains open to negotiations if Washington changes its approach.
The goal of our trade negotiations with the United States has always been to get the best deal for Canadians. Never a deal at any price or on any time frame. Well, we made progress, and we did make some progress in recent weeks. In the end, that momentum reversed, and we could not accept what the U.S. had offered, nor could we give what they asked.
U.S. Treasury Secretary Scott Bessent has threatened economic punishment against any country doing business with Iran as part of what he calls an economic D-Day campaign to end nearly 6 months of the war.
I want to emphasize that we are spreading out across the world as we speak, that you will see a wave of sanctions when you leave this meeting today, and you should expect that cadence to continue. And I would expect that you will see a major announcement of a financial institution being sanctioned by the end of this week.
Bloomberg senior editor Derek Wallbank joins us now. And Derek, we know that the Maximist economic pressure campaign against Iran is really a pressure campaign against the likes of China, right? Is this going to set the US and China on a collision course before we get to that leadership summit?
Well, Heidi, I think that's really a key question, right? What I think there were some people in the markets were expecting that when Bessent came out with all of this, he was going to lay out exactly what was going to happen, exactly what all of these consequences were going to be. Instead, this was sort of a preview, if you will, a precursor to a lot of future actions, restating the threats, to be sure. But the severity with which the United States is going to deal with China and or any other major Iranian trading partner has yet to be determined. You heard from Bessent in the clip that you played saying that he expected a major financial institution to be sanctioned by the end of the week. There's a big difference between that and actually hearing which firm that is, what name that is, which we don't have. Now, the U.S. has any number of range of options available to it you're really talking here about secondary sanctions, and those can kind of be very wide. But there really is a question of how much that's going to go. There is a meeting expected between Xi and Donald Trump next month. Historically, the U.S. and China have tried to not want to do something that would upset those meetings before, even though we have in previous instances seen one or both sides, sort of raise the temperature a little bit before. But we wouldn't necessarily be expecting something that would sort of up-tip the entire relationship to come right before. That said, if you don't go take China as a serious focus of this, then what does it say about the overall campaign when China is the predominant buyer of Iranian oil?
Yeah, and Derek, to that point, will this even work? Because authoritarian regimes have proved very difficult to dislodge in the past, just using economic means. So what's the chances that this actually gets somewhere? Is there a template for this?
Well, Paul, I think a lot of analysts have noted the fact that Iran has been under significant U.S. pressure now for decades, and it has not bent there. There, reports that we've had and others are suggesting that more hardline folks are in charge in key positions in their military operations than they were before the war, and so maybe there's less of an appetite, even potentially for talks now than there were then. The theory of the case from the White House right now is that economic pressure, if applied at scale, will allow them to bend. But economic pressure, as you quite rightly mentioned, comes with a lot of trade-offs. And one of the key pressure points that the U.S. is going to be facing is simply a factor of the calendar, which is that Donald Trump wants to be running a hot and good economy into the midterm elections in November. Those dates are set for the election. And, if there is something that comes with consequence, be it gasoline prices at retail, diesel prices, accessibility of fertilizer, anything else that it might be, or any sort of retaliation China or others might impose, that would have an economic cost ahead of the midterms. And the United States is not the only nation in the world that is aware of when those midterm elections are.
Bloomberg senior editor Derek Wallbank there with the latest. More ahead here in the Asia trade. This is Bloomberg.
Let's check in on how Australian data centre stocks are tracking at the moment. This is following an announcement from the Prime Minister that Australia is going to be legislating to enforce a national standard on data centres' use of electricity and water. This is just to ensure that household utility bills don't get out of control. Bit of a mixed picture here. We've got NextDC off by about 1.6%, but Digico and Goodman Group both pushing a little bit higher. These two are perhaps a little bit more diversified than some of the stocks that we're seeing some declines on at the moment, Haidi.
Yeah, and elsewhere in the markets, of course, this is all about going into those NVIDIA numbers and some of the conversations that are being had when it comes to NVIDIA's price hikes as well, in terms of how this affects the broader AI trade. So it is a 7-day losing streak when it comes to NVIDIA, or down another almost 3%. We are seeing that pass through when it comes to the heavyweights, of course. The Kospi overall down by close to 3%, Samsung off by 3.3%, and SK Hynix down by over 5%. We did have a little bit of news flow when it comes to the labour union side of things. Hynix's labour union rejecting a tentative wage agreement that was reached with management. That's according to reporting unit Yunhap there. So we continue to watch for that, because union leaders and management had reached a tentative agreement before putting it to a membership vote. So we'll continue to see if there are any further developments there. We also have the US reportedly asking South Korea to invest in memory chip production facilities in the country to ensure stable chip supplies. That was apparently a conversation that happened during the industry minister's visit to Washington recently, also according to local reporting, Paul.
Let's take a look at what's happening in Japan at the moment. We do have the Nikkei losing some ground as well. We're off by about 0.8%. It's chip stocks that are bearing the brunt of the selling at the moment. You see Kioxia was down there about 1.3%, Advantest pushing lower too. Bit of a gap, though, between the rest of the stocks. There are other pockets of the market that are performing reasonably well in Japan. We have more ahead on the Asia trade. This is Bloomberg.
With China earnings remaining in focus, Temu owner Pinduoduo posting a mixed earnings print. XPeng, in the meantime, revenue outlook fell short of expectations. Its robot unit set to raise $900 million from the likes of Alibaba and Tencent. Our Asia Equities reporter Winnie Su joins us now for more. Let's start off with Pinduoduo. What were the elements here that investors were concerned about?
Yeah, so as you mentioned, it's kind of a bit of a mix. So the overall earnings were actually quite strong when it comes to the net income and also operating profit beat expectation. But the drag is coming through from the second quarter revenue, which is coming at 112.4 billion yuan versus an estimate of 115 billion yuan. And the drag is mostly coming through from the transaction services, while we're still seeing online marketing services actually quite a plus. So for investors, they are focusing on just how overall the company is still navigating some of these global challenges when it comes to the compliance, when it comes to these tax from European countries, for example. So really trying to find that balance between how they manage these global challenges and some of the more domestic businesses. So what they like about the domestic businesses is actually how the company seems to be deepening some of its supply chain integration, expanding further to the rural areas, and also looking at some of the better fulfillment progress that the company is actually having. So we are also seeing some progress coming through for its 100 billion yuan merchant support program, actually helping some of its companies to show higher profitability on the platform as well.
XPeng is out fundraising as well, 900 million, looking for money for its robot unit. What are the implications of this for the market?
Yeah, so I feel like for the broader market, it really goes to show how there is such an active fundraising activity going on for all of these tech companies. But interestingly, for this one specifically, when you look at the 900 million US dollars, it's about the size that we saw for Unitree's A-share IPO recently. And the breakdown of this is that $600 million coming through from external investors, 200 from XPeng itself, and 100 from some of the executives. And the significance of this is that it really shows the capability of the company moving from just an automaker to humanoid robot makers. And Citi actually had a note just now in the morning saying that XPeng is probably China's closest comparable to Tesla as an integrated physical AI company, and that they see this as a long-term positive. Well, of course, when you look at just the share price reaction, it was mostly reacting to how the earnings coming through as a miss. So missing the quarterly earnings expectation, but also seeing vehicle delivery guidance, a bit of a guidance forward, a bit of a miss as well. But overall, when you look at the longer term, the transition into being able to become a humanoid robot maker is still seen as quite positive.
How do investors view the disconnect between China's IPO boom recently and the broader weakness that we see in the market?
Yeah, it's quite interesting, right? Because we just talked about Unitree plus CXMT. Their recent debut actually has been quite strong, and you saw share prices jumping an average of 370% since July, while during the same period of time, Star 50 index was down about 30%, while CSI 300 also lost about 8%. So that divergence goes to show you how the optimism and the enthusiasm for the IPO market is also a reflection of lacking confidence in the secondary market. Now, this is coming through with different reasons, different factors, including how there is a lack of catalyst after that global sell-off in the chip stocks, and that the economic picture of China really remains very weak, especially what we saw in the recent economic numbers. So investors are seeking for opportunities in tech, and at this point, it seems like they are seeing more opportunities in the IPO market, while some of the other names that are already listing continue to show weaknesses through earnings results as well.
All right, Bloomberg's Asia equities reporter Winnie Su there. Let's get to the top corporate stories that we're tracking. Bloomberg's been told that Taiwanese prosecutors have indicted a senior NVIDIA manager as part of a group that allegedly smuggled advanced AI chips into China. Sources say 2 senior employees of Supermicro Computer were also indicted. They're accused of organizing the shipment of 74 servers containing high-end B300 chips into China via Japan and Indonesia. And that was a breach of US trade restrictions. Elon Musk says SpaceX plans to launch its first AI satellites equipped with NVIDIA chips in the 4th quarter of next year. In a post on X, Musk says the orbital data centers will hit significant scale in 2028. SpaceX pinned its blockbuster IPO in June on pioneering space-based data centers as a lower cost and more environmentally friendly alternative to land-based facilities. The US SEC is said to have sent subpoenas to major Wall Street banks over the hedge fund's situational awareness. Sources say it's seeking information about trading activity at the hedge fund, which came under pressure last month. Situational awareness liquidated some of its positions amid a barrage of margin calls during an AI stock rout before Citadel stepped in to buy the bulk of its bets.
Private equity managers have found a new way to drum up cash as they seek to calm investors frustrated by record low payouts. Firms are raising cash through structured equity deals that blend debt and equity features. Our Bloomberg Private Markets reporter Laura Benitez joins us now with more on today's Big Take. Taking a step back, what are preferred equity deals? What sort of fueled the growth in these sorts of transactions that we've seen in recent months?
It's really interesting. So as we know, private equity managers have been struggling to sell assets for some time now because of a mismatch in valuations and a rise in interest rates. And that spurred all sorts of different ways and techniques of trying to unlock cash to give back to existing investors who have been waiting rather a long time for their money back. In this particular story, we've dug into preferred equity, which is essentially when a new investor comes in and injects capital. That capital gets used to repay existing investors in this particular case. And for the new investor, they can negotiate all sorts of sweeteners, future upsides and warrants. And they can also negotiate a fairly quick-ish exit in some cases as well. So it can be a win-win in certain situations. But we've seen huge growth in this particular area, which is why we dug into it for this story.
So what else are private equity firms doing to unlock distributions to investors?
Well, as I said, because this has been going on for some time, like in particular the last 2 to 3 years, it's really spurred all of these different products and strategies that are designed to unlock cash. So there are things like NAV loans where you lend against a portfolio of assets. There are also secondaries where you're selling stakes of funds. There's continuation vehicles where you're selling assets onto a different fund. And they're all designed to cash out existing investors if they want to be cashed out. That is, but yeah, there's huge growth in this market, and it's actually sort of pioneered this fund finance market, which 5-6 years ago was probably around half the size.
How do investors feel about these sorts of financial engineering techniques?
I think, a few years ago we were seeing more resistance and more pushback, and there are certainly still cases of that. But I think overall, investors have become more pragmatic, and it is a solution for many. And I think it's becoming more normalized. So I think it's definitely something that investors are getting more used to. However, I do think there are still certain situations where we'll see lots of pushback, and we'll certainly be looking out for those as they come through.
All right, Bloomberg Private Markets reporter Laura Benitez there. Still to come, Alphinity Investment Management joins us to discuss the companies emerging as Australia's earnings season winners. That conversation next. This is Bloomberg. Let's check in on a couple of stocks that reported earnings here in Australia this morning. Let's start off with the Woodside Energy. We saw first half net income beat estimates, net income rising 27% to $1.7 billion in the 6 months through to June. Of course, Woodside benefiting from some of those higher energy costs we've seen due to the conflict in the Middle East, supporting or offsetting to some degree some of the production difficulties. Coles Group, meanwhile, started off in negative territory, now pushing higher by about 0.7%. Net income for the full year did miss the average analyst estimate. There is still a dividend, 37 cents per share, although that is a bit more than expected. But the liquor division taking something of a beating, profit there down almost 50% on year as Australians apparently are drinking less. Haidi.
Or CSL, ASX, Treasury, Wines and Z among Australian companies that hit the reset button during the 2026 financial year, and investors who kept faith in some of these restructuring leadership efforts reaping rewards. Signs of progress unveiled during earnings season, seeing some boosts there to those stocks. But let's get a little bit more of an assessment when it comes to this earnings season and the outlook. Elfreda Jonker is a portfolio manager and investment specialist at Alphinity Investment Management. Elfreda, always great to have you with us, and I love this. Price for perfection, delivering for average, and overall uninspiring.
Yes, I was probably a little bit dramatic there with my description, but I think it does ring true. If you look at the current reporting season here in Australia, it has been not necessarily disappointing because overall earnings are coming through sort of in line with expectations, but it really has been commodities dragging most of the sectors up. And if you exclude that, average earnings growth for this season is currently sitting around 5% only, relative to an average of 10%. So overall, it doesn't look like a lot's going on, but underneath the hood, we have seen quite a bit of dispersion, not just across sectors, but also within sectors where companies are beating or raising estimates, and those that's just coming in line.
I was going to ask if you do buy the miners, but one of your top conviction calls is actually BHP. But what we were talking about earlier, how these iron ore miners are now copper miners.
Yeah, absolutely, and it is one of the key reasons why we have increased our position in BHP. If you look at their recent results, more than 50% is now copper. And copper is one of those base metals that we believe are geared to a number of structural trends that's supporting it, not just the AI build-out, but also electrification and renewables. So for us, BHP is still one of those. Yes, it is our biggest stock on the ASX, and it's probably a little bit of a boring pick, but for us, it is one where we believe with that balance sheet, fantastic management, and importantly also the capital management that they've just announced again, increasing dividend, increasing buyback. There's a lot of support for BHP from here. So it definitely does deserve a position in a portfolio in Australia.
Yeah, the materials sector have been performing pretty well as a whole, which stands in pretty sharp contrast to what's going on in the other heavyweight sector on the ASX, which is financials, banks particularly. How much of what's going on with the banks is idiosyncratic, and how much is it due to rates rising and all the tax changes we've seen around the property market?
Yes, I think it's probably a combination of all of the above. If you look at all the banks, effectively, they have reflected in this results season that the consumer in Australia is a bit softer. If you think around all the challenges that we are facing here, it is, higher interest rates, housing prices coming down, confidence is just not there. So they are seeing that impact coming through on mortgages. So at this point in time, pretty much all the big banks are seeing earnings downgrades, and they've come from a period of relatively long period of earnings upgrades. So for us, this is a sector where we have been reducing exposure with a preference of some of these other financials, AMP, Macquarie, starting to look a lot better than what they were over the last few years.
And how do you see that property story playing into broader consumer sentiment as well and consumer stocks?
I think it is a big deal. A big part of the Australian wealth is sitting in the property market. So currently you have already seen a big drop, and I think it is also about the expectation from here. A lot of people are standing back, not wanting to buy because they expect a lower price. And if you think about the biggest portion of wealth for the Australian consumer sitting in housing prices, and you're uncertain of where that's going, in an environment where inflation is higher and potentially interest rates could still increase as well, I think it is playing a really big part, and that is what you're picking up in the outlook statements from a lot of companies this reporting season, is that more cautious tone, particularly around the consumer. And really, it's a confidence game. And at this point in time, there's not a huge amount that's benefiting the Australian consumer to be more confident in what's ahead.
I wanted to ask your views on AI because, as you point out, Australia is kind of the anti-AI trade. You see the days when the oil price goes up, the energy trade comes roaring back as well. But do you think there are opportunities, particularly we know that both sides of government at the moment are trying to come to bipartisan consensus on what AI data centre build out, guardrails look like. Are there opportunities for this economy and Australian corporates that might benefit from that?
Yes, I definitely think so, and particularly in that data centre space. There are many companies that's busy building out data centres, Goodman and XDC being two of the bigger ones, but there's also a huge amount of private companies that's building out, and that is going to support construction, commodity companies. And I think for us, if you look at how we invest in AI globally, we sort of look at the various different stages of that AI ecosystem, and we like to invest in sort of different companies across that. So here we do think that a Goodman Group is a good company, longer term growth. They are betting big on data centers. So we do think that is a good option. But then on the commodity side, like we said, BHP and the copper, a company like a Megaport is sort of seen as a bit of a neo-cloud. And then there are those companies that's been adopting AI and rolling out AI products to improve efficiencies. Companies like Codan, Ventia Services yesterday, again, talking about their VenLens. So we do think that this is an environment where currently, to date in this reporting season, more than 60% of the companies have talked about AI and what they're doing. The majority of that is about improving efficiencies, reducing costs. So I think the overall economy here will benefit eventually. I just think because 2% of our benchmark sits in technology, we are not seen as one of the major beneficiaries of that AI build-out.
To some degree, do you see the ASX acting as a hedge against the AI story as well for global investors?
Definitely, I think so. And you could see that, as Haidi mentioned recently, every time there is an off AI day, Australia is benefiting. And it's not just...
Well, today, case in point.
Exactly, today, case in point. And really, it's also benefiting from the Asian flows. If you think about Taiwan, South Korea, these markets have become AI markets with TSMC and SK Hynix and so forth listed there, whereas we don't have that. So definitely, I think we are seeing as a hedge, and time will probably only tell if that's going to be a good thing or a bad thing overall. I think for us, the important thing is really just stick to your investment process, stick to those companies that you're looking for, and have a diversified exposure, not just to AI, but also those companies that can continue to improve their earnings profiles from here.
We've spoken about BHP, but take us through some of the other top picks stock-wise.
Yeah, so I think across the industrials, we really like Ventia Services. It really is more a servicing business. And what we like about that is that they're quite exposed to a number of sectors in the economy. But more recently, they have been tilting back to defence. And that is one where there is a structural underpin, not just in Australia, but globally, companies or countries are spending more on defence. And that's a higher margin business for them. And as I've mentioned, also the AI overlay, they're already starting to roll that out. So we like that as a beneficiary, strong management, really doing a lot on costs, and of course also that capital management portion that we're seeing a lot of. So Ventia is one. And then I think some of the other companies that's really surprised in this reporting season that we like are names in the sort of financial space, like AMP. They've come through quite a difficult period, a number of years of earnings downgrades, and we think they are now at the point where they've done a cost reset. So we have been seeing a lot of positive revisions coming their way, not just on their strategic wealth business, but also I think a lot of what they've done over the last few years have reset that cost base for them, and also expanding on their platform business. All that investment in technology is now coming through. So you're seeing that AMP North platform benefiting from flows, And then also what we like is that offshore exposure. They are recently seeing really good results from the investment in China, and we expect more of that to come through. So again, capital management, but it's one of those businesses that in a tougher environment, they're doing a lot of self-help and also trading at a reasonable valuation. So that's another one that we really like as well.
All right, Elfreda, thank you so much for stopping by with your views today. That is Elfreda Jonker, Client Portfolio Manager at Alphinity Investment Management. And we have more on Australia ahead every Tuesday, 10:40 a.m. If you're watching in Sydney, that is 8:40 a.m. in Hong Kong. This is Bloomberg. The Trump administration is proposing a new way to charge companies for each candidate they sponsor for a visa under the H-1B program. Now, this is after the federal court struck down its earlier attempt in June. Let's get to our immigration reporter, Alicia Caldwell, for more. So, Alicia, what's the latest with this?
Well, the administration announced today via a technical posting that they'll now charge $103,000 for any new H-1B candidate, whereas the previous rule applied to just those who were outside the U.S. So this now is expansive and covers all 85,000 visa seekers who would win a lottery every year. And it appears the goal is to both raise money and possibly reduce the use of these visas. The government estimates it would generate $8.8 billion that would then be used for a variety of immigration programming, including immigration enforcement, roundups with ICE and so on.
What does it potentially mean when it comes to the future of the H-1B policy?
You know, there's a lot of differing opinion, but generally speaking, a lot of folks I talk to who are both supportive and those who are not say this will stranglehold it. It will limit those who, companies that can use it and thus likely shrink it. In some instances, folks told us, this would shrink it out of existence. One individual described it as, sort of a brain drain policy, that it would eliminate also, foreign students who rely on the avenue or the opportunity for an H-1B when they decide to come to the U.S. to complete their studies.
Our immigration reporter Alicia Caldwell there with the latest. We are about to head into the part of the day where China markets come online. So let's take a look at how we're setting up, given that we continue to talk about this real kind of disconnect between what we've seen as a series of blockbuster IPOs, but the broader market remains to be a languishing one that is actually getting sort of a bit worse. The fresh trading narrative is deeply needed for China. And will that come in the form of any kind of fiscal bazooka? It doesn't seem like that is happening. We've had a series of commentaries by the Communist Party's official newspaper suggesting that the signalling looks like the odds of the kind of big-time stimulus in response is going to be pretty low, those odds at this point. At least at this point, Beijing seems to be downplaying the impact of the slowdown. So that is bad news typically for stock investors. That really kind of used to be a situation where you get bad data and the markets would rally because it's a sure guarantee that we'll be seeing some fiscal attention. But Taiwan futures looking like we'll track that broader US chip sell-off down by 0.7%, and A50 China futures just lagging there as well. Also worrying about those overcapacity tariffs of 7.5% from the US too.